Hi everyone, and welcome to the Week 2 InvestSMART Bootcamp webinar series. I'm Tom Wilson and I'm the instructor of the bootcamp, but also one of the product specialists at InvestSMART. So if you've got any questions at all, this is definitely an interactive style webinar. And on the right-hand side on the control panel, you can actually ask questions. So definitely go ahead and pop in a question there if you've got anything that you've encountered during the week 2, which is module 3. And I will have a look at it and do my best to answer. And if I can't answer the question online, I'll definitely take note of it and get back to you afterwards with a more detailed answer. You can also pop in comments there as well. So if you think that you've got a comment on something, put it in there and I'll happily have a look at it and even bring it up during the webinar at the same time. Okay, so as always, there's the disclaimer, and I can only give general advice. I can't give any specific financial advice. So please take that into account. So this webinar, like the others, the main purpose of it is just to cover off any questions from the learning material that you might have encountered so far. Can't give any financial advice. We have to stick to the course content. So module 3 is about different investment vehicles. Unfortunately, we sort of can't go into specifics in terms of recommending stocks or talking about certain investment vehicles that are outside of the content, but I can definitely do my best and point you into the best direction or where the resources are. Intelligent Investor, for example, has stock recommendations on its website, and you should have set up access to both Eureka Report and Intelligent Investor for a month. So definitely make full use of that, and we'll refer to that throughout the course and also this webinar. And that's the last point, I guess, is to make sure that you're actually using the available resources that you've got made to you. So week 1, which is last week, we covered off module 1 and 2. And we'll just have a quick recap that you should have a goal. And in the example I was using was that I wanted to save for a house deposit. We know the time or the time frame it's going to take, which is 3 years. And the risk profile, well, for me, I'm fairly comfortable with risk. I definitely don't want to go backwards. So if I'm saving up for a house, I don't want it to be in a risky investment where there's potential I could lose money that would go towards my house deposit. We also looked at diversification, which is spreading of risk and making sure that you're not just stuck in one asset, and asset allocation. So depending on your actual investment profile or your risk profile and what you've determined, what's the percentage of your money that you've worked hard for do you put into each asset? So do you put a certain amount into shares, a certain amount into ETFs, etc.? And you can always go back on the bootcamp LMS, which is the learning management system, and you can actually watch week 1's webinar there as well. And that will stay there, and we'll keep adding to them as we go through. So module 3, we're talking about different investment vehicles. And I guess it's like a typical or fancy financial type way to say basically different things that you can invest in. They use the term vehicles because I guess it takes you somewhere and it can be used to help grow your wealth or help you with your future. So I've broken it down into shares and ETFs because they're very similar in how they operate, managed funds and managed portfolios. Then lastly, cash and bonds. And this is obviously in the written content on the bootcamp, but what I'll try and do is give you a little bit more explanations and also bit more plain English. And you can also ask questions, so don't hold back. So with shares, these are the most common asset or investment vehicles. A lot of people, in particular, the ones I speak to at InvestSMART, 'cause we handle a lot of clients from Intelligent Investor and also Eureka Report. They'll all have their own share portfolio. So they've gone out and they've bought, sold, holding on to different shares, whether they be mostly Australian shares, but also international shares as well. So how do you actually make a profit from it? Well, buy low, sell high. So you're looking for an increase in value. So the difference between what you bought it at and what you're going to sell it at. And that is called capital appreciation or capital growth. That's always what, is a fantastic way to obviously grow your wealth, is if the share actually does go up in value. Not always. It can go backwards, and we've seen that with a number of shares in the past. The other way, and this is a way that sometimes a lot of people don't tend to factor in to their investment, is earning income from the actual share itself. So Australian shares in particular, compared to their US counterparts, we tend to pay more dividends. And because you're technically an owner of that company, you have a share in that company, you're essentially getting an amount of the earnings paid back to you. Not all the shares will pay dividends. Some, particularly US shares, they tend to retain their earnings, so they keep them and they use them for further investment. And I think I touched on it last week. Nathan Bell, who is the head of research for Intelligent Investor, he's got a very interesting viewpoint on this, particularly with banks. He said they should be paying out the dividends to investors, because when it comes to them hanging on to those earnings and trying to invest them themselves into certain projects, they haven't really done a good job. So it's probably better to go back to the investors themselves. So make of that what you will. I guess it depends on what they're investing in, but looking out for dividends is always really good. And there's some tools I'll show you as well that will show you how to look at dividends, what companies pay, and even when they do pay them. So with shares, it's always important to remember you'll need a broker to trade them. That's not always the case. You can actually have IPOs, which is the initial public offering. So when a company or even a fund first lists, they won't go straight to the ASX. They'll actually have an IPO where you can directly contact that company and take up a number of shares from the outset. The shares then go onto the ASX, which is the Australian Securities Exchange, and that's when they will trade in what's called a secondary market. So you're buying and selling of different people. And you need a broker to do that. And you can there's so many online brokers nowadays. These aren't any recommendations, but obviously ComSec is well known. There's others such as NabTrade and even IG, which is a bit more of a CFD broker. They also have a stock broker offering as well, where you can buy and sell physical shares. So you've got to remember that you've got to pay brokerage to buy the shares, and you also have to pay brokerage to sell the shares as well. So it is important to have a look at what brokerage you are paying. I know that in the past, you had some of the brokers charging you up to $30 for a trade just to buy shares. And if you were someone who had, say, a day trading mentality or perspective, where you wanted to buy them in the morning and then sell them that afternoon or even a day later, that can get quite expensive. So you're looking at like a $60 round trip, they call it, So to buy and then exit, so buy and sell the shares. There's so many different strategies when it comes to share trading or share investing. Value investing and growth investing is quite popular, and we'll definitely look at that next week as well at the strategies webinar. But if you wanted to, in the meantime, jump onto the Intelligent Investor website, and they've got a whole explanation of value investing on there. So what we'll do is we'll have a look ourselves actually at the Intelligent Investor website, and I'll just jump across to that now. So I've gone forward 1 2 minutes. Okay, here we go. So the Intelligent Investor, this is a subscription service, but with Bootcamp, you actually get 1 month free. So definitely make the most of it. And you can see on the front page here, they've got their research. So they're talking about companies like Audinate, which are fantastic reads. It's really good reading what the analysts have to say about each company. And I find myself getting stuck reading all this research here just to get across what different companies are doing. But they've also got recommendations, and you can see here that there's some that are actually written here just on the article. But we can go to the top and go to recommendations, look at the latest, look at the buys, the holds, the sells, and even there's that explanation of value investing there. So if I hopped into latest, it will take us to the most recent ones that the Intelligent Investor team have put up. So it looks like as of today even, they've done Audinate. So they've changed that to a speculative buy. And that's the other thing. It's really good to understand, what does that mean, the speculative buy? So you can actually see at the top here, the recommendation types. So I might even just quickly open that, and it will go through what each one means. So a spec buy, for example, is saying these stocks have the potential to produce higher returns, but comes with higher risk, only suitable for investors with that higher risk. They're accompanied by a low maximum recommended portfolio weighting. So what they also do in their recommendations here, they actually even say that the max weighting should be around about 3% of your portfolio. So that's a really handy feature. And as I said, you've got the research here as well. And you've also got, for shares, some filters here as well. So you can jump into share prices, and the filters will allow you to search for different shares based on whether they've had an update, like they've gained or lost in the last 7 days, their different market capitalization, so the size, even by sector. So you can see here that it's thrown up BHP at the start. It tells you its market cap, its market capitalization, its current price, and it even shows you right to the right here the dividend yield, which is 5.49%. So the amount of dividends you get compared to the share price. So obviously you want that to be taken into account when you're looking at the dividends. There's also, back at the top, the stock screens. They do talk about dividends here as well. And this will allow you to search for all the different dividends that are coming up or have been paid, whether they're franked in different amounts. So it's a very handy feature just to, if you are someone who is investing in shares, just to keep an eye on that so that you can be aware of when dividends get paid. Usually you'll also receive information from your broker as well. Should point out that Eureka Report, I don't want to leave them out because they do a good job too, but they actually do interviews with all the different CEOs and other important people in the company, economists, for example, as well, on different shares. So you get a bit more of a behind the scenes look into a lot of those companies. And Alan Kohler, which a lot of you may have seen on the ABC, and he writes for the Australian as well. He's the head of Eureka Report, and he often does a lot of the interviews himself. Okay, so I'll just get back into. So ETFs, which is exchange traded fund, these can sound a little bit technical, and they can also sound a little bit scary because it's an acronym for a start, but an ETF is basically just a fund or a group of shares, for example, that they trade on an exchange. So you can buy and sell them like a share on the ASX. That's what it means by exchange traded. And it's a fund, obviously, as well. So it's basically, the example I like to use is that you can track the Australia 200. So the top 200 shares, you could go out and buy each one individually, or you could wrap them up in a sense in an ETF. And the benefit is that you get the exposure to 200 shares. You only pay brokerage once because it's a one ETF. Whereas if you were to say to go and buy those 200 shares, they'd all be separate. So you'd have to buy each one separately, so BHP, Commonwealth Bank, Telstra, and pay brokerage on each one. If you wanted to track in index as well, you'd also have to make sure you've got the right percentages of its weightings, because each of those companies that make up the Australia 200 index all have different percentages on how much they actually influence that index. So there's different types of ETFs. There's active and passive, and one that tracks an index would be determined as a passive. So basically, there's no one in control of it actively choosing to buy and sell here and there. It's just choosing to get the market return less any fees. An active one would be, like I was mentioned, like a team of analysts that would sit there, do all the research, and then decide to buy and sell different shares. So you get stock ETFs, which is the most common, bond ETFs, which are quite handy, and they give. In the past, it was quite difficult to purchase bonds in the secondary market or on the exchange. That's much easier nowadays, but a lot of investors who like to invest in bonds, they will go onto their broker and they'll actually purchase bond ETFs. And there is a question here from Jason. Thank you so much for your question. And it says, what are the best methods for a retail investor to purchase bonds? So that's definitely one of them. You can purchase different government bond ETFs or even bonds from private institutions such as banks or other companies. I'll show you some tools coming down the track as well. But basically, that's some methods. And when I get to the bonds section of this talk, there's actually one of the contributors to Eureka Report, and she's in the bond industry, and she's written so many articles that I'll show you that as well. So you have also sector or industry ETFs. These are really handy because, say, for example, you're someone who's got Telstra shares, you've got other bank shares, for example, but you wanted to get exposure to a certain sector of the Australian economy, such as mining. You can actually go out and buy ETFs that will have mining stocks in them. So that gives you exposure to that specific area of the Australian economy, of the Australian stock market. There's international ETFs, and we use a lot of these ourselves in our own managed portfolios that InvestSMART offers. And these give us really easy access to international shares. So not just US, but also Hong Kong, Singapore, UK, Europe, for example. Commodity ETFs, they're quite popular as it gives you access to say, commodities like gold or other kind of interesting metals or different, tea or coffee type commodities. I'll touch base. There's some out there that are leveraged. So what that just means is that it's increasing the risk, because when it does move up or move down, it can actually magnify or multiply the movement. So essentially what it's doing is, because if it's a leveraged ETF, you're basically putting in $1 and they're allowing you inside that, or they do it themselves, but they turn that $1 into 10 by borrowing the $9, and then they go out and they purchase a larger amount. So you might see, especially if you look at a broker or even on a tool, I'll show you in a little bit as well, you'll see some that will say leveraged or 3 times or 2 times. It just means that that one has been leveraged, so that a movement that might normally just be $1 up, $1 down, if it's leveraged, it could go up 3 times. So in the past, I've seen investors who have not known that, and they've jumped onto those kind of ETFs, and when something happens in the market, their outcome could be much worse, because it's basically being leveraged up, or the trade itself has been magnified. To confuse you a bit further, sometimes ETF providers even do things such as inverse. So a good example is, if gold goes down, an inverse ETF would actually let you profit from that trade. So with shares, you can sometimes, instead of buying them to make money when they go up in value, you can actually do a thing called shorting, and that's profiting when it goes down in value. So it's a similar concept with inverse ETFs. What I tend to say to a lot of people that ask us questions about ETFs is, just stick to straightforward ones that track indices or give you exposure to certain sectors, or even international ETFs or commodities. Try to, I guess, just use a lot more caution when it comes to ones where you see the word inverse or 3 times or leveraged, because they are riskier. Factor ETFs, the last point there, they're an active style. So there is someone who is behind the scenes choosing what goes into that ETF. And there were some that different ETF providers have offered in the past, ones that will track the robotics industry, for example, but they'll choose specific shares that go into that. But that's a little bit more complex than what a lot of people are trying to do sometimes. But they're very interesting. Let's have a look at the next slide. So I often refer back to this for an ETF. You can see here that you've got Aussie shares. Obviously, some of them are in the top 200 there. They've been wrapped up into one, product, which is the ETF. So if I wanted to get access or exposure, they call it, to a certain number of shares, in this case the top 200, I can just buy that one ETF and it'll automatically give me the proper exposure to any movements in the Australian 200 index. So you'll need a broker again to trade, and it's very similar to the shares. You've got to pay brokerage to buy the ETF. You've got to pay brokerage to sell the ETF. We went through the different types of ETFs. Now, as with anything in the finance industry, everyone wants their cut, and the ETF providers, because they're doing this for you behind the scenes, they're basically packaging them up into an ETF. They're doing the buys and sells themselves. They're paying brokerage at their end to, say, buy different shares and then sell them. They'll charge you what's called an MER, or management expense ratio. It's basically a fee. It's their way of making money. And they do have, we are getting them to do this for us, so we do have to pay them something. But One of the best things about ETFs that you've probably seen on the bootcamp course is that they are quite inexpensive. The cost is usually only about 4 basis points, so 0.04%, which is quite low. So it does make it quite economical. So we'll have a quick look at the tools again, and I'll jump to the Eureka report because they've got a really handy filter at the top. And so I'll go to filter tools, exchange traded funds. So here you can actually search different countries. You can search by the different management types, asset allocation types. There's one that we use at InvestSMART. I'll see if I can just type in the ASX code, which is IZ, which didn't work. That's okay. What if I just go, ones that's focusing on Australia, and I'll just say find ETFs. Oh, there, I could have done security name at the bottom. Order by code, sorry. Okay, so if we go through them all, obviously there's a massive list of them here, and we can sort of refine this down further if we had to, but I'm just going to find one that's interesting. I mean, even better shares, they even do like a cash or a high interest cash ETF. So I'll click on this one. And what this one is doing, and you can go to their website and get specific details, but what this is doing is it's wrapping up various high interest products that will give you returns and give you exposure to, say, if you wanted something fairly defensive, you could look at something like this and put cash into it, and you would get investment returns paid to you. So this is more of like an income producing asset, lower risk, lower return. And it does actually, I mean, we've got articles associated with this as well. I'll just see if we get some more information here. So it's talking about the asset allocation, what it actually has. Obviously, it's 100% cash. So it's trying to beat the 30-day bank bill swap rate, which is quite low anyway. And it invests all of its assets into bank deposit accounts within Australia, pretty much the big four there as well. So that's an interesting way to look at it. The thing is, you just have to make sure that the returns are worth it, because you do pay brokerage. If you go through a broker, you'll be paying a brokerage fee to purchase it, hold on to it, and then to sell it as well. So that's always something to take into account. But you can see here, these are the dividends that they've paid over the last number of years, actually. But you can find on that filter just so many different types of ETFs. I'm sure if I typed in the robotic one, it would come up with something maybe. Here we go. Yeah, so it was Better Shares that did offer that robotics and artificial intelligence ETF. So it's basically trying to follow any shares they believe involved in the manufacture of that or exposure. So definitely do your own research. This is not a recommendation by me, it's just something I find interesting, that they can create ETFs to track different sectors or different concepts. But it's definitely worth having a look at. We tend at InvestSMART, particularly with our portfolios here, I'll just quickly show you an example. We tend to follow passive. These are passive investments. So we're just trying to get the market return less the fee. And you can actually scroll down and see the allocation and what we use. And you can see we use that AAA one I was telling you about, Better Shares. That's for the defensive part. We also have that IOZ, which is the BlackRock iShares Australia 200 ETF. So that's just tracking the Australia 200 and trying to get the same return, less any fees. So I'm going to go back and just start the presentation again. Oh, the other thing I should have mentioned is the Q&A. Eureka Report has the Q&A with Alan Collar, and that's fantastic. So if you ever get stuck and you want a question answered by him, every Thursday he'll go through the bag of questions he gets and answer as many as he can. And I definitely say to you, just make the most of that, because he often even gets experts from outside to give us a bit more information. So I'll just go into the next topic. So managed funds, you probably would have seen a similar type of diagram. Basically, a managed fund is you have a group of investors and they'll pool their money together, hence the little pool photo on the right-hand side. And I wish I was by a pool at the moment. I'm in Melbourne and it's a little bit cold today, but that's the least of our concerns at the moment. So basically, when you pool it into an investment, they'll have a price on the value of that pooled investment, and you're basically buying a piece of it. And a good example of trusts like an REIT, a real estate income trust, you can purchase part of it, and then when it comes time to get out of that investment, you either, depending on if it's unlisted or listed, you'll sell it back or it will be redeemed by the fund itself. Got a lot of good points and bad points, which I think we've gone through in the bootcamp content. One of the biggest things is that you don't own the underlying asset. You'll just have a portion of that fund, so you own it. So when it comes, if you wanted to say transfer that to another person or to a superannuation fund, for example, you might have a capital tax event because you're going to essentially be forced to sell that holding if you wanted to change it. Whereas if you own the underlying assets, you can usually do things like in-specie transfers and not actually have the sale go through. So the managed funds, they're obviously managed by someone who will look after that for you and choose depending on what type you choose. If it's a real estate income trust, it might be a company that is building commercial buildings or even apartments, for residential apartments, and they might have themselves a managed fund put together where you can buy into it and then sell out of it and get exposure or invest in that particular area. So there's two different types. There's listed, and the listed ones are trading on the ASX, so you can purchase them that way. And then you've got unlisted as well. Listed investment companies, they often get referred to as LICs. So one big thing is that you just have to be aware of a lot of managed funds, of their fees. That's one big thing that can stop your investment from growing. Sometimes you'll see them just have an open percentage. So they might say 2% on your entire investment value, and that can add up over time. Some also have performance fees, which if they go above a certain benchmark, which often they choose themselves, which is a little bit suspicious. I'm not saying all of them do this, but just have a look at what benchmark they're choosing. They should be choosing an industry standard benchmark. I've seen some in the past just say their benchmark is whatever the RBA interest rate is, and obviously that's quite low at the moment, so that is a much easier target, and then they can charge a bigger fee. So we luckily have a lot of tools. Intelligent Investor, they even offer their own form of a managed fund, which I'll show you briefly, and that trades on the ASX under the stock code INES, so INES. And then there's Eureka report. And obviously, we do a lot of interviews with fund managers. You can filter different searches, and they've even got specific managed funds and LIC filter searches there as well. So I'll quickly jump onto the Intelligent Investor. And at the top here on their line, they've got portfolios. So the model portfolios here are basically what makes up these portfolios. So the shares that they buy and sell within them. So you can track them yourself. You could hop on here each day and look at it and decide to follow what they do and do it within your own brokerage account. Alternatively, you could get a managed portfolio, one of these top three here. So they do it for you. And then this is the one I was talking about just before. So the ethical share fund, which is INES, I'll hop into it. And what this is, it's the same kind of decisions that are being made with investments. So you've got the team at Intelligent Investor who are actively, so each day reviewing everything, deciding to buy, deciding to sell. And these ones have an ethical mindset as well. They'll do that for you, and then they'll trade this managed fund on the ASX. So you can buy it as you would a share, and then you've got a piece of that. So that's an example of a listed fund. And it will go through and talk about different allocations as well in here. The other thing is with Eureka Report, they've got their filter tools. So they've got their managed funds, and there's so many different types of managed funds. Oh, I just got a question here from Denny, which is fantastic because we get asked this a lot, even when we have clients who call us up. Who determines what is ethical? They will put in their PDS here, and I'll just open it. Hopefully it should just give it to me as opposed to making me download it. They'll actually put in there what they determine as ethical. It might have sent it somewhere else, but basically they're avoiding different companies that say might be involved in oil or petroleum or different areas that harm the environment itself. I believe, I'll see if I can get the actual just going to see if I can try and get the PDS up on screen for us, but it seems like it doesn't want to. Yeah, I'll have to see if I can find the PDS. You should be able to do it as well. And there is a whole section there in terms of what they determine as being ethical, because I can see your point, like it can be subjective. We've had clients in the past ask us questions like this, and there's some that they might consider ethical as another person wouldn't. So there is a procedure or formula to it, but it's explained more in detail in that PDS there. So what I'll do is after this, I'll see if I can send it to you unless you've already got it, because it does explain it quite fully. It's actually a bit of a growing trend at the moment. There's a lot of investment groups that are offering ethical investments. So they're definitely gaining in popularity, and there's a lot more companies now that can be made up. Like you can look at US companies like Beyond Meat, which has been very interesting in terms of its growth over the last couple of years. And there's a lot more that are starting to get into that sector as well. But yeah, so we can also, with the filter, we can go sorry, I'm on the wrong one again. Filter here, we can actually do listed investment companies as well. So we can, very similar to the ETF filter, and we can choose various different components here and then search for it as well. So you could look at a company like Acorn Capital Investment Fund, and it'll give you information in terms of price, financials, announcements, dividends. Change in directors' interest is always interesting, and I think we'll cover this off a bit more in the strategies module, but it's basically keeping track of directors in the company that are buying and selling different parcels of their own shares. So often if you see a director maybe buying into a company, it could be an indication that something might happen or they've got confidence in the company. And the same is for the converse, where if they are selling out, and there's other directors as well that are selling out of a company, it might be a sign of something else might be afoot. But we'll cover that a bit more in the next webinar. And mentioning there was also interviews as well. So Alan Kohler does interviews with a lot of the managed fund CEOs and investment advisors as well. Just go back to the presentation. And thank you for all your questions so far as well. It definitely is very handy, giving me an idea of what you might need a bit more help with or a bit more of exploration to a certain topic. So managed portfolios, well, the best way to think about these is if you had your own portfolio, say you bought 30 or 40 shares, it's very similar, but someone else is going to manage it for you. So in this case, there's an active version where they'll be picking and selling, buying and selling the shares that go into it. They'll do that on your behalf, and they'll usually do all the reporting as well that goes with it. So you can essentially invest with them and they'll take care of everything. The passive version, which is what InvestSMART offers with its diversified capped fee portfolios, for example, what we do is we'll get the investment from you, then we'll purchase the different assets, like I was showing before, that make up whatever portfolio you've chosen and manage them for you. So we'll do the rebalancing if needed. We'll do all the reporting as well. The managed portfolios, you own the underlying assets. So compared to a managed fund where you're just buying in and then buying out at a unit price, you actually own the underlying assets, which is quite handy because if you ever decided to transfer out to a broker because you want to do it yourself, that's entirely possible. You don't need to actually sell your investment and then repurchase it somewhere else, which could cause a capital tax issue, amongst other things. There's numerous different managed portfolios. A lot of companies offer them. One of the biggest things, again, is just fees. You just need to be really careful with companies that will charge you uncapped fees. So if a company is charging you 1% or 2% on your investment, that can grow quite quickly. So just always be aware of that. The same again with the performance fees. Sometimes they'll choose a benchmark that they try to beat, which is very favorable for them. So just be aware of that as well. So the InvestSMART group itself, which I've gone through already, we do offer passive type portfolios, managed portfolios. The intelligent investor, they'll offer the active portfolios. So I might quickly just show you what I'm talking about. So we did see at the top here, there was for intelligent investor, there's the portfolios. And if we say looked at equity growth. What this is, it's a managed portfolio where if you give them a certain amount of money, they'll invest it in line with their mandate here. So they're basically focused on capital growth by investing in Australian equities that they think are undervalued, and they've got their own metrics to determine what how it's undervalued, and they do talk about on their website about value investing. But for example, you can actually hop in and see up here the model portfolios and look at growth, and it will show you what they're doing, what they're holding, what different shares. So they hold some cash as they all do, but then there's the different individual shares here as well. So like I was saying at the start, you could do this yourself. You can actually open up a brokerage account with the broker and then follow their portfolio here and buy and sell whenever they update it. Or if you invested into a managed portfolio, then they'll do it for you. So as soon as they make the decision, it's done at our end. But if you were deciding to do it yourself, you'd have to wait for them to publish that trade, and you'd have to be checking on here as well, so that you could reflect that in your own account. You also have to do your own reporting, whereas the managed version, we do the reporting for you as well. And InvestSMART, we have touched on these, but if you look at Invest with us, you've got the diversified portfolios here. And depending on what suits you in terms of your goal, time frame, and risk profile, there's different portfolios here that are managed and they're passive. So they don't have someone behind the scenes actively sitting there day in, day out, researching everything, buying and selling. It's basically passive investments designed to track different markets like Australia 200, the ASX, and get that return less any fees. The biggest thing with the InvestSMART portfolios that we're pretty proud of is that we cap our fees. So you'll start off at $99 for a year, but then once you've invested more than $82,000, and you can split this up amongst different portfolio types, it caps out at $451. So we've got clients that will ring us up and they'll invest maybe $200,000 and they'll only pay $451 per year in fees. So that's money that stays in your pocket, helps you to grow your investment quicker. It's something that we're sort of trying to change the industry from within in that respect. It's important to note though that if you look at the Intelligent Investor active portfolios, like the one we're looking at before, they don't cap their fees. They actually have a percentage type based model, which I don't think you'll get that capped fee type scenario with an active portfolio, just because there's so many people involved behind the scenes, so they've got to pay for more heads, I guess. They're always trying to beat the market as well, the active. Like passive is saying, we'll just accept the market return, less any fees. Active is saying, no, we're better than what the market can do. So we're going to go out there and try and beat what the market offers. Hence why, another reason why their fees are a bit larger. So coming to the last investment vehicle here, there's cash and bonds. So we specifically are talking about risk-free cash and bonds, or risk-free assets. And that basically means that there's no risk that your capital won't be returned to you. So that's usually done through government bonds in particular, and savings accounts or term deposits at banks, and they're banked by the certain guarantee that the government offers there as well. I'll show you, because there's a question here from Jason just on how the value of a bond can change after you've purchased it. And what you'll find with bonds is the price, so they will pay out a coupon, or they'll pay out like an interest rate or an amount to you. Depends, like usually it's every quarter or every month or even every year. The price of a bond has an inverse relationship to interest rates. So when interest rates will go up, the bond price will go down to reflect it, and vice versa. But I was going to show you as well, because there's one piece here on the Eureka report. If you go and check out, go to the experts and go to Elizabeth Moran, she has written so much on this, and she's got so much experience with bonds, hybrids, deposits, and she's even now educating investors about fixed income. So if I look at her articles here, she wrote one 4 hours ago even about high yield shares, investing in growth. I'll just have a look. Because she's done a very good article for you, Jason, that will just talk about everything you need to know in terms of. She did like a step-by-step. I'll see if I'll put more of her articles on my page here. And it's basically like a bonds basics. So if I just open up part 1 and part 2, there's actually part 3, she was busy. So in this bonds basics area, she's talking about the face value of bonds, and basically she'll talk about that inverse relationship here as well. So this is a really handy way to look at it. She talks a lot about other bonds as well, apart from government bonds. So that's quite interesting too. That's not something we touch on in the bootcamp content, but we might add it a little bit later. But I've found myself reading a lot more about this, that it's not as scary as what I thought. Often a lot of people think bonds are very complicated, but they're an essential part of any investment portfolio. Having that fixed income asset is definitely a more defensive asset to have. So it's definitely something that a lot of people should know about. And that's part of it. You can get into different types of bonds that may be a bit riskier. And she does talk about things like hybrids. But you can see here she's going through all the different types, how the coupon rate. I'm seeing part 3 as well. And she even talks about how to buy them as well here, and the bond yields. So she's talking about the face value at maturity, so what you get back at the end. She's even risking the risk and return based on different bonds. And you can see here that government bonds are virtually or no risk. So they're going to be at the very bottom, but also their increasing returns quite low. But you can see hybrids, what I was talking about, higher risk, but you also get the higher return, and then the high yield bonds as well. And she'll go into even further about like ones that are rated at different levels. And you'll probably remember back in the GFC, there was obviously there was like the junk bonds. A lot of people were investing in them because they had a much higher return, but obviously in hindsight, much riskier as well. But yeah, bonds are definitely a very interesting topic, and I'd implore you to definitely have a look at that because she's got so much information there. There's a question here too from Fiona just saying, hi, I see portfolio weightings against recommendations in Intelligent Investor. Whilst I know they're associated to risk, how are the weightings determined? There's a number of ways they determine the weightings within portfolios. They've actually got investment committee within Intelligent Investor who will actually review this on a monthly basis and look at whether or not the weightings are correct. But it also comes down to the research done by the analysts as well. So it's a combination. It's basically them making a decision on how much exposure within that actual portfolio they want towards different areas. So it's very active. So there is someone behind it. There's actually a group of people who are determining that, and that's based on their experience and any other kind of information they've got in terms of what the market's doing. To contrast that, you might ask, well, what about the passive version? So the InvestSMART ones, and you can go down to here and you'll see our allocations. And we've got, for the high growth model, as you'd expect, most of the investments within equities. And then you might say, well, how do you determine that? We've got a committee as well, but what we do is we'll look at all the different peers that are invested within the same investment type. There's about 523 peer funds, and we'll follow a similar mix as them. So what it's doing is allowing us to track what the industry is tracking, which means less people involved to have to do all this research and planning, which is how we bring the costs down as well to track, to offer the uncapped fees. So I think we might be getting very close to the end of this webinar. So I'll just load up the present screen again. For some reason, it's slow like me on a Monday. Looks like it doesn't do anything, which is handy. Basically, I believe that the next screen anyway is going to be the questions screen. So if you do have any other questions, definitely go ahead and ask them now. I'm happy to wait if you wanted to go through anything in particular that we've covered off, or if you have any questions about the content that you've been looking into so far. It's definitely a good time to do it now. This particular module is always going to be, I guess, quite chunky because we're trying to talk about the different things that you can invest in, but trying to make it as straightforward as possible and not making it too complex, like going to a university course, for example, where they'll talk about bonds or talk about shares over a period of 2 months. We're just trying to boil it down for you where we're giving you an idea of how they operate, but also, how you could go about it yourself as well. And the resources that we have available, such as the Intelligent Investor, where you can see what people are thinking, like the experts about different shares, use the filter tools to find different ETFs, managed funds, etc. That's something that you should definitely be using if you're going to go it yourself. If you don't want to go it yourself, well, that's when you look at things like managed portfolios or managed funds. It's a question here from Sandeep about options investing. It's not something that we really cover in the boot camp. My personal experience with options, I used to work at a broker myself, and there's so many different strategies that can be used. It may not be the best time to talk about it now, but I can definitely point you into direction. You could do a bit more research into it. You've basically got some types of options such as calls and puts, when you are buying them, they're what's known as a limited risk trade. And by that, I mean that upfront, you're paying for the option, and the option is basically giving the right to exercise that into the future. So usually by a certain date. So for example, if I said that InvestSMART shares, maybe they're worth $1, I could get an option that says in the future, I can buy them at 80 cents at a certain price. So I pay for that option up front, and it might cost me a certain amount of dollars. And it's like a ticket to almost play that game in a sense, because as soon as you pay that, you're going to be forfeiting that amount. So then when it comes around to the date when they're about to expire, you can take them up. But obviously if they're much below the price that you were hoping to get them at, so less than 80 cents, they essentially become worthless because you're buying them at a higher price. The opposite to that is if you were to sell calls or puts, you're basically doing an unlimited risk trade where it can go against you quite quickly. And a lot of particularly CFD providers will offer these kind of trades, and you can open yourself up to unlimited risk on some of them sometimes, which is usually not the best way to go about it. But definitely maybe do some research. I'll see if I can find some information I've got here about them, but yeah, it's quite limited in terms of options. So if there's no other questions, what I'll do is I'll make this available so you can watch this again through the bootcamp course, and we'll always do these each week. And next week we'll be looking at the week 2 content. So if you've got any questions for that as well, you can always, when you register for that webinar, pop them in there, or you can even email us, as I know some of you have, invest@investsmart.com.au. And we're always happy to answer your questions. You can even hop into the InvestSMART website, and there's that intercom button at the bottom right, and you can chat live to one of us as well. So thanks so much for your participation, and we'll leave it there, but I'll see you again next week.